Welcome to TradeLogAI Academy. In this lesson, we're breaking down mark price versus last price, and why this difference can decide whether you stay in a trade or get liquidated. In the next slides, you'll learn what each price represents, which one drives your P&L, and which one triggers liquidation. Here's the core problem. The price you see on the chart can be misleading. On a single exchange, the last traded price can spike for a moment, because of low liquidity, a large market order, or even manipulation. That spike might look like the market moved, but it can be localized and temporary. If your account health is judged using that one noisy price, you can get unfair liquidations, even when the broader market never truly traded there. Now you need to separate two different prices. On the left is last price. That's simply the most recent trade price on your exchange. It's what you see on the chart, and it's the price your orders usually get filled at. On the right is mark price. This is an estimated fair value, calculated from a broader index across major exchanges. And most importantly, mark price is used to measure account health and trigger liquidations. So, last price is what you see. Mark price is what can liquidate you. Here's why mark price exists. Stability and fairness. First, it helps prevent unfair liquidations caused by short-term, manipulative spikes on a single exchange. Second, it anchors your position to the broader global spot market, not just one volatile order book. And that's the key point. Liquidations should only happen when the real market value moves against you, not because of a temporary wick on one platform. So mark price is basically a protection layer. It filters noise and makes liquidation rules more fair. Now let's simplify it into one rule. Different prices, different jobs. Last price is for execution. It's the price that actually fills your buy and sell orders. It determines your entry and exit, and once the trade is closed, it's what your realized P&L is based on. Mark price is for calculation. It's used to calculate your unrealized P&L, your floating profit or loss while the position is open. It also acts as the reference for your liquidation trigger, and it's how the exchange checks your margin health. Here's the first example. Why mark price acts like a protective shield. Imagine you're short BTC from $50,000 and your liquidation price is $52,000. On your exchange, a large market buy hits the order book and creates a quick scam wick. For a moment, the last price spikes to $52,500. So, if you're only watching the chart, it looks like you should be liquidated. But the mark price is anchored to a broader market average. It only rises to $50,200 and never reaches $52,000. Because liquidation is triggered by mark price, not last price, your position stays open. So the takeaway is simple. A single exchange spike can hit last price. But if mark price doesn't cross your liquidation level, you're safe. Now, example 2. This is the silent liquidation scenario. You're long BTC from $50,000, and your liquidation price is $48,000. The key detail? The contract on your exchange is trading at a discount compared to the global spot index, so the two prices drift apart. On your chart, the last price is $48,500, so it looks like you're still safe above liquidation. But the mark price, the price used to measure your position's health, has dropped to $47,900. Even though the last price never hit $48,000, the mark price crossed your liquidation threshold. And because liquidation triggers on mark price, your position is closed. That's why traders sometimes say, "My chart never touched my liquidation price," but they still got liquidated. Here's the most common misunderstanding. Myth. If the wick on my chart doesn't hit my liquidation price, I'm safe. Reality. Most charts are showing the last price, the most recent trade on that exchange. But liquidation is triggered by the mark price, and mark price is calculated separately from a broader reference, so it can reach your liquidation level even if the chart's wick never does. So the rule is simple. Don't trust the wick alone. Track the mark price when managing liquidation risk. What should you actually watch on your screen? If you want a true picture of your position's health, focus on 3 numbers. First, mark price. This is the real reference for your unrealized P&L and how close you are to liquidation. Second, liquidation price. That's your hard line in the sand. If mark price reaches it, the position gets closed. Third, margin. Margin is the collateral securing your trade. Adding margin can push your liquidation price farther away, giving you more breathing room. So, mark price, liquidation price, and margin. These are the 3 that matter. The golden rule. Last price executes your trades. It's what you see on the chart, and it's what your orders fill at. But mark price determines your survival. It's the price used for unrealized P&L and liquidation. So if you remember one line from this lesson, make it this. Last price is execution. Mark price is risk.